Welcome back, everyone. Let's jump right into this week's explainer, covering August 10th through the 15th. We're looking at a massive, high-stakes tug-of-war happening right now across the markets. On one side, we've got beautifully cooling inflation numbers that have Wall Street literally popping champagne. But on the other side, we've got a seriously cracking everyday consumer. Oh, and right in the middle, a completely stalled set of crypto regulations. It's a wildly fascinating dynamic, and we're going to break down exactly what it all means for your portfolio. Here's our roadmap for today to help translate this week's absolute fire hose of data. We're going to hit the macro melt-up, the cracking consumer, big money moves from Uber and Oracle, the crypto doldrums, a special spotlight on SailPoint, and finally, the week ahead. All right, kicking things off with Section 1, the macro melt-up. We're starting top-down here with the kind of macroeconomic good news that is driving the S&P 500 into a state of absolute euphoria right now. So, July's core CPI just dropped, and it came in at exactly 2.5% year over year. Guys, that is the coolest inflation reading we've seen since way back in March 2021, literally before the entire post-COVID inflation surge even got off the ground. And because of this beautifully cool number, the probability of a September Fed rate hike just completely plummeted, dropping from 44% down to just 34%. For the markets, this was the ultimate green light. And man, the market's reaction was immediate. Just look at the scoreboard. The S&P 500 didn't just tick up, it smashed into fresh all-time records for the third straight week, closing just a hair shy of 7,800. It's now up 14% year to date. But here is the crazy part, the VIX fear gauge. It dropped all the way down to 1450. That is its lowest level of 2026. This right here signals total market complacency. Wall Street is fully 100% pricing in a perfect soft landing. Moving to Section 2. The consumer is cracking. Because let's step outside of Wall Street for a second, right? We really need to look at what's happening on Main Street. Because how the market feels and how the everyday consumer feels, those are two completely different realities right now. Friday hit us with a pretty brutal reality check, a negative 0.6% drop in July retail sales. Now remember, the market was actually expecting a 0.1% gain. And alongside that miss, the University of Michigan Consumer Sentiment Score just fell off a cliff to a preliminary 51.0. To put that into perspective, the historical average for that index is 84. So yeah, 51 is low. The consumer is really feeling the cumulative weight of inflation, high interest rates, and a labor market that, let's not forget, just lost 23,000 jobs in July alone. So the absolutely crucial point here is what we like to call the translation. Right now, we're living in this weird twilight zone where bad economic news is actually being treated as good news for stocks. You might be wondering, why? Well, weak consumer data means the Fed probably won't hike rates, and lower rates tend to lift equity valuations. But listen, you have to be so careful here. We've got to watch closely for the exact moment when this so-called bad news stops being a reason to buy stocks and transitions into a genuine, undeniable recession signal. All right, let's pivot to Section 3, big money stock moves. Let's see exactly how this macro tug-of-war translates into specific micro opportunities. We're starting with a truly massive week for Uber. The stock had an absolute breakout week, surging 10% and completely erasing its recent post-earnings dip. And they did it by delivering this incredible trifecta of catalysts. First, a massive deal with Pony.ai to roll out 2,000 robo-taxis across 5 European cities. Boom. Then, they announced a partnership with Hino Marukotsu to enter Tokyo, which happens to be the world's most valuable taxi market. And to top the whole thing off, legendary investor Bill Ackman's Pershing Square disclosed a brand new position in the stock. What we're seeing here is the entire investment thesis being validated in real time. Uber is proving it's the ultimate global distribution network. Pony.ai wins in Europe, Waymo wins the US, Hinamaru wins Tokyo, and Uber? Well, Uber just collects a toll on all of it. They don't have to build a single autonomous car themselves, they just monetize the network. And that right there is exactly why the stock surged. Now, I also want to translate this massive value gap for Oracle, a stock that it seems like the broader software sector just completely forgot about. We're looking at an entry price around $143.78, which is a staggering 57% below its 52-week high. But then you look at the fundamentals. Their earnings grew 36.5% this past year, and they literally just inked a massive $7 billion cloud infrastructure deal with the Pentagon. When you pair that with an average analyst target of over $247, it highlights a massive glaring disconnect between how the business is executing and where the stock is currently priced. Moving on to Section 4, the crypto doldrums. Because while equities easily found their inflation catalyst to hit those record highs, the crypto market is a totally different story right now. It is currently stuck in this frustrating, range-bound summer doldrum, with Bitcoin just kind of hovering around $62,874. There is a massive disconnect happening here, too. Over in traditional finance, the big players are charging ahead. Goldman Sachs is dropping $2.25 billion to buy Neos so they can own a Bitcoin income ETF. Kraken is pushing boundaries by rolling out 24/7 S&P 500 trading. Fidelity is out there trying to turn Ethereum into a yield-generating product. But then you look over at Washington, and regulators are just slamming on the brakes. The SEC recently canceled a really critical vote on tokenization. And that highly anticipated Clarity Act, completely shelved until September 14th. So Wall Street is fully ready to go, but these stalled regulations are keeping a very firm lid on crypto prices. Okay, let's dive into Section 5, our spotlight for the week, SailPoint Technologies. We're going to look at a brand new, incredibly urgent cybersecurity challenge that they are solving better than anyone else on the market right now. So we all know the drill with traditional human cybersecurity, right? Making sure an employee's password isn't stolen, setting up two-factor authentication, all that stuff. But think about this for a second. As companies deploy autonomous AI agents, software that can actually read your CRM, write to your database, and literally send emails on your behalf, those AI agents need identities too. If an AI copilot has the keys to sensitive corporate data, governing that autonomous AI agent is absolutely the critical new frontier of cybersecurity. And that is exactly where SailPoint enters the chat. They just launched a product called Agentic Fabric, specifically to secure these AI agents. This gives them a massive first-mover advantage in a space that is literally about to become mandatory for enterprises. The numbers back it up, too. Their annual recurring revenue is growing at 28%, already hitting over $1.1 billion, and they've got their sights set on $2.1 billion by 2029. The analyst consensus right now is a strong buy, with the data pointing to a strategic watchlist entry zone right between $15 and $17. This is definitely one to keep a close eye on, especially as we get closer to their September 9th earnings report. Finally, Section 6, the week ahead. Let's map out the impending catalysts, because as we all know, the market never sleeps, and you need to prepare your portfolio for exactly what is coming down the pipeline next week. Get ready, because we are entering an absolute gauntlet of data. Tuesday and Wednesday bring us Home Depot and Target. This is going to be key to telling us if contractor spending and discretionary spending are actually holding up. But Thursday is the main event. Walmart's earnings report is the ultimate litmus test for the health of the American consumer. If Walmart comes out and says their shoppers are trading down or pulling back, then that July retail weakness we talked about earlier wasn't just a blip, it's a bona fide trend. And then Friday rounds it all out with the flash PMIs to give us a real-time pulse on manufacturing and services. But honestly, all of this data we just talked about, it's really all building toward one massive pivotal date. August 27th. That's the day we get Fed Chairman Wirsh delivering his keynote at Jackson Hole, which is pretty much going to set the tone for the entire September rate decision. And, as if that wasn't enough, on that exact same day, we also get the undisputed heavyweight champion of earnings season, NVIDIA. It's going to be huge. So as we wrap up this explainer, I want to leave you with one critical question to really chew on before the opening bell. If we get to Thursday, and Walmart confirms that the everyday consumer is genuinely cracking under the pressure of this 2026 economy, how long can Wall Street's euphoric, bad news is good news melt-up actually survive? Keep your eyes on the data, focus on the fundamentals, and I will see you all next time.